Welcome to Deep Dive. My guest is Swayam Saurabh, who is the CFO of JSW Steel. Swayam, thank you very much for joining us on Deep Dive. To begin with, 2025 has been a year which was a year of pressure for the steel industry. Uh, as you exit 2025 and enter 2026, how do you see the sector emerging from the issues, especially with respect to pricing, volume growth, and profitability?
Thanks, Ajit. Thanks for having me here. As we enter in quarter four, which is the first quarter of this calendar, we are far more positive because during last quarter, due to uncertainty around safeguard duty, prices actually went multi-year slow, which basically creates a lot of pressure, which we saw. But towards end of December, the safeguard duty were restored. They are now there for 3 years. That helped with sentiment. So, we enter into quarter four far more positive. We think our margins should expand in this quarter. As we look at next year, we will have higher capacity because blast furnace 3 should be, fully available end of March. We are confident about domestic growth. India, consumption grew about 7% for first 9 months. We think 7.5% will be this year's full year's average. But similar growth we should expect, going into FY27 as well. Because if you look at it, despite double digits growths which we saw for last 4 years, including 7 to 8% this year, the per capita consumption of steel in India is just 115 kgs. Global average is about 240, 230, 240 kgs. So we have the headroom to continue to grow like this is fairly large. And we are confident about India as a market, and with safeguard coming in, I think it does create a little bit more stability in terms of pricing and margin outlook.
To give us a sense for the industry, how pricing power is at this point in time. We have seen pricing bottoming out in December 2025, and since then in January we have seen price hikes also happening there. But the pricing trend, how has it been in the last calendar year, and how do you see going into 2026?
Look, so if I go back to March, earlier this year, March, April, that's when the first time safeguard came, and we were under severe pressure, the entire industry prior to that. So we saw prices going up. In fact, in quarter one, HR prices went about 3,500 rupee per ton. But once we went towards close to quarter two, safeguard was expected to be renewed for 3 years. That started to create uncertainty. Safeguard expired in November, and although it got finally renewed after 1.5 months, but that uncertain period created severe pressure on prices. And the reason for that, in my view, are two. One, this year we saw, multiple new capacities coming in, and capacities come lumpy. So, when capacities start, you basically need time as a country to absorb. But the positive, again, I see is India as a country is creating about 12 to 14 million ton of new demand every year, which simply means that, a 5 million ton capacity will take about 4 months to fully absorb because the demand is growing. But the other reason which also created pressure in quarter three is China. And China, if you look at last 3 years, I mean, 4 years back, China used to export about 65 million ton globally. Today, I mean, last year it was 120 million ton. And this year we expect, I mean, the CY25, we think the number would have been anywhere between 132 to 133 million. So the problem with China is while the production is moderating, demand is still falling, creating a further demand needing to export, which creates pressure on global prices. And we are a connected world, so that also affects pricing in India. But as I look ahead, there are two positives I think will help us in next financial year. One, China demand contraction seem to be stabilizing. Plus, China has announced anti-involution, which also means some production moderation will happen this year. So CY25, we saw about 4% production cut. We expect this trend to continue. So when your production is, continuously moderating and you find your bottom for the demand, I think that would be the time the pressure to export out of China will come down. Number two, in FY27, we don't see large significant capacities coming in India. So these two put together, we think will create a more stable pricing environment in FY27. Of course, we have to watch out for cost. So, for example, coking coal right now is seeing seasonal, disruptions in Australia, which is, actually pushing prices up. Coking coal has been holding around 200, 210 for last 2 quarters. Right now, this is at 240, $250 per ton. But we also think this will also stabilize. So all in all, with higher volume, better price visibility, and of course, better control on cost, especially commodity like coking coal and iron ore, we expect a better year next year.
One point on the capacity additions, because there's a sense that there's already overcapacity which is there in the Indian market. Plus, there's additional capacity that you said has been added over the last 12 months. Is that a risk for pricing going forward?
I don't believe so. So when we started the year, you saw new capacities coming in. So our, JVML, which was fully commissioned during the year, plus a couple of other competitors who also sort of started operating at full capacity. But if you just consider a fact that India as a country is creating 12 to 14 million ton of new demand, you would basically understand that even if a new capacity comes, let's say 5 million ton, the impact will be max a quarter, quarter and a half, because then this capacity will get absorbed. So we did see that in FY25 so far, FY26 so far. But if you look at FY27, and if I look at the capacity which are going to come, I don't see a lot of new capacity coming. And if you blend with the fact that China should see more stability, I think the demand and supply in India should be fairly balanced. But if you go further 1 or 2 years, we think there'll be time when capacity will not be enough to cater domestic demand.
And so you will have industry putting up additional capacities going into the next 2 years?
Well, I mean, steel capacity takes 4 years to build. I mean, we build it in 3 to 4 years, but if you look at, average, it can actually take longer. So we have a good view right now on what capacity is coming next year, the year after, and perhaps the year after, because anything which gets announced now will perhaps be available in FY29 or FY30. So the point I'm referring to, because you can't just tap, switch on, switch off capacity. We do see a time over next 3 years where, you'll see supply shortage. But going into FY27, we think demand and supply will be fairly matched.
You mentioned the fact that steel demand is expected to be 7 to 9% in 2026. There's a better policy clarity now because the safeguards have come into place. But do you still see, infrastructure spending to be much more faster, and especially recovery in the housing and the auto demand to be sustainable?
I believe so. So, budget is around the corner. We would know, what government plans to spend on capex. Last year, the plan was 11.2 trillion Indian rupee. I think they are fairly well on track. But last year, we did not fully see, capex from private players. So private capex did not take off as much as we hoped it to be. That's positive, possibly a tailwind for next year. Also, the effect of rural demand. I mean, if you look at, some of the large, actions government has taken, for example, around GST, this will be consumption positive because it creates larger income, disposable income in people's hand. This should create new demand, which would, help housing, which would help sectors like auto. So all of this put together, we are confident that the 7 to 9%. I mean, this year India should grow anywhere between 7.5%. It sounds like a lower growth given last 4 years we have been growing in double digit. But as I go into next year, government infra spending, private capex starting to contribute, and better consumption-driven demand from, for example, rural, which would also positively impact sectors like infra, and continued momentum of renewable. We should see similar or better year next year in terms of demand.
How do you look at the demand scenario if I break it up into products, flat products and the long products? How is it looking for you from a demand and pricing environment point of view?
You're referring to next year?
Yeah, next year.
Well, I mean, if you look at our mix, about 80% of what we sell is flat. If you look at mature markets, I mean, for example, global average is about, 55, 60% versus 45%. But this mix we have chosen because this allows us to actually be far more efficient in terms of margin management. So if you look at in our total mix, about 60% is value added in special product. I mean, one reason we have been able to hold our performance well is this VASP. What it does is it sort of decommoditizes you as a steel player in a way. For example, 15% of what we sell goes to auto sector. Now that then becomes, the risk shifts from a steel risk to a sector risk. So we have been focusing on flats, and we think the flats demand, even going into next year, should hold around 7 to 9%, if not higher.
How do you see the HRC prices from here on? Because that's that's a product where you saw maximum price impact there, and it seems now the prices are bottomed out for HRC. Do you expect a strong revival coming in?
We hope so. I mean, if you look at December, the steel players increased HR prices by about 1,500 rupee after seeing multi-year low. In January, there was a further price increase of 2,000. But even current prices, if you go back 2 years, you realize that these prices are significantly lower than what industry has been seeing as a steady state price. So I do think there is a room for prices to further go up. But of course, there are a number of dynamics, variables which are involved. We are positive about prices potentially going up in future.
You have the India-EU trade, which has been signed off now. There is still some clarity requirement with respect to carbon border adjustment mechanism. What is the kind of exposure that you may have there, and what is your interpretation as of now?
So look, I mean, if you look at JSW Steel, gradually over last few years, export in our total mix has been coming down. And this is, this goes back to our fundamental premise that capacity which we are making is for India, and India will have enough demand to consume even future capacities. So export to that extent is a filler, if I may use that word. Of course, when you have lumpy capacity coming in, the need to export goes up. But export is not a segment we are targeting to create capacity for. But having said that, if you look at our history, indeed, whatever exports we have been doing, Europe has the largest share. So we are fully, we are understanding the risk CBAM could bring, but we see a lot of positives as well. If you look at prices in Europe, they have gradually been inching up. So we think some price increase will happen, which will offset part of the risk, margin risk we have of, quantity we export to Europe. But also we are preparing ourselves to be compliant to CBAM. So if you look at our growth plan to 51 million ton and beyond, the new capacities which we'll create, one of them is going to be a low emission steel facility near Mumbai. And it might take another 3 to 4 years for it to fully come up. But when it comes up, we will actually be, largely compliant to CBAM requirements.
Just to get an understanding, Swayam, for our viewers, when you say that you're trying to become low emission, is it easy for an existing industry to be compliant to CBAM immediately, or they will have to change their manufacturing processes, move away from thermal or coal to electric so that they become low emission steel? What is kind of cost which has to be incurred for that?
Uh, Look, the way to see this is, CBAM allows for a transition. And if you look at, FY34 is when the allowance becomes zero. But it does have a mechanism where, gradually year over year, the penalties for carbon content in that steel goes up. That's the transitionary provision. The way we see it, we are leader in India, and we think, given the fact that steel as an industry contributes about 4% economically, but is responsible for almost 12%, 11.5 to 12% of emission, we have a responsibility to lead this change. But this need to be done in a responsible way. And while a green steel in our view at this moment is not economical, there are ways and means where you can bring down your emission level very significantly by making minor investments. And Salau as a facility is one of them, where we will replace coal with natural gas as a fuel, and it will be an electric arc furnace which will use DRI as input. And you will see that the emission from this facility goes down to third. And that then meets, the CBAM requirements for the volume which will supply. But if I take a step back and I go back to the point around being responsible, we as a company has taken this lead for many years now. We were the first one to raise a sustainability linked bond in 2021, which was first by any steel company globally. And out of that, we have made a commitment to go to 1.95 ton from a base level of about 2.4 by FY30. So this is a natural transition for us, and we think this transition will also not only allow us to stay competitive while transitioning to a low emission steel, but also sort of demonstrate our leadership and our sense of responsibility getting delivered by lowering emission, for the world.
Just to get a sense, Swayam, what could be the cost of conversion to a green steel or semi-green steel for an Indian company, given the fact that you are undertaking that maybe a metric ton? What is the differential which is there, which Indian companies will have to undertake if they want to look at Europe as one of the key markets?
So I'll give you a very high level math. If you use hydrogen as a fuel, which is the holy grail of where everybody needs to reach. You will a typical steel from BF route, translates into about 2.4 ton of carbon dioxide a ton of steel. This is our baseline. If you use hydrogen, theoretically you could actually go below zero point 0.4, meaning you are knocking off 85% of emission. But the problem is cost of producing hydrogen is because it's going through its own innovation curve, is very high. I mean, it would be unsustainable for companies to actually produce steel using hydrogen as a fuel and stay competitive unless there are government subsidies, etc., which we don't have. So what we have is essentially a mechanism where our existing facility, you could have an electric arc furnace, use DRI as an input. The facility will be powered by renewable energy, and instead of coal you use natural gas as a fuel. Now so from 2.4, this could take the emission down to 0.7. Of course, green steel by its definition means emission level of less than 0.4. So while I'm not 100% there, I'm 85% there. But in this process, I'm still competitive. So coming to your question, of course, it depends on where natural gas prices are. But our expectation is it will not be, more than 2.5, 3,000 rupee more than producing steel traditionally, which is done today via BF route. So of course, it'll be slightly more expensive, but it'll be very, very competitive irrespective.
It would also mean that if Indian companies are able to successfully navigate this process, the steel that they're selling in the European market would be higher by more than 3,000, 4,000 rupees per ton?
Well, what consumer pays gets determined independently because market has its own pricing dynamics. Uh, in the end, in my view, it's demand and supply. If there are more people willing to supply low emission steel at a certain price, that's where the price gets determined. But I would like to make just 2 points here. One, we are taking, this transition irrespective of Europe. And as I said in the beginning, as a company, our focus is only India. And we think India, even, in future, even Indian customers are going to demand, lower emission steel, and we are preparing ourselves to that. The second point is essentially, none of the capacities we have made or going to make are designed for export. This is different from, our competitors sitting in South Korea or Japan or even China, where part of the capacity is always earmarked for export. For us, the exports which are done essentially to, bridge the gap between the supplies, which sometimes come lumpy, and the time domestic demand takes to absorb. So we are less worried about it. Of course, if you have new capacities coming in, domestic market do not immediately absorb. You will have to find avenues to export. And we think with the product mix and also Salau eventually coming in, we will also be competitive in export.
Finally, I just wanted to get a sense of, we are signing so many FTAs with many of the, trading partners there. That opens up new markets for us. Do you think that, going forward, that is the way, like green steel is the way for us if we want to be a bigger player in the global markets?
Should be. I do not know if it will be, but it should be, because I think we all have responsibility towards environment. But, to give you a clear answer, I go back to my last answer. We are not making capacities which are designed for export.
It's a positive time, but we can talk more about the steel industry sometime later as well. Thank you very much for joining us from Singapore and taking out time for deep dive.
Thank you.